뉴욕나우. 안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 뉴욕 특파원 강영연입니다. 오늘은 케니리 로무라 이코노미스트와 현재 시장에서 이슈가 되고 있는 인플레이션 그리고 금리 인상 등에 대해서 이야기를 해봤습니다. 케니리 연구원은 지난 10월에 그러니까 페드가 이렇게 매파적으로 변하기 전에 저희가 인터뷰를 한번 했었는데요. 그때는 2022년 페드가 금리를 인상하지 않을 것이라고 예상을 했었습니다. 지금 시장을 보는 게 어떻게 달라졌는지, 왜 달라졌는지 비교하면서 보시면 좋을 것 같습니다.
We think the growth in the S&P 500 will remain pretty strong in 2022, but possibly less so than in 2021. Also, investors should still continue to expect elevated volatility, at least for the first half of this year, given that the pandemic is still ongoing. And also, even though the outlook for the US corporate sector will remain positive and still strong economic recovery will continue to support the US equities, uncertainty will still remain high as the markets continue to interpret evolving Fed's monetary policy outlook this year. Currently, we expect 3.9% growth in 2022 after the strong recovery in 2021. And that forecast is still slightly higher than my colleagues at Nomura's forecast for the developed market economies, which is at 3.7%. That relative strength is not a lot compared to the previous year. But ongoing economic normalization in the US, particularly for service sector consumption, and strong household balance sheet for this year should keep the growth above potential pace of growth well into at least second half of 2022. But we do see some headwinds. We no longer expect the Build Back Better Act to pass in 2022, resulting in essentially more fiscal drag this year. And also the spread of Omicron variant is a downside risk as it could delay the normalization of supply chain disruptions this year. I think for now, our understanding is that even though the case growth is very high, led by the Omicron variant, the cases so far have been milder than compared to variants in the past. And also, I think the US economy overall has learned to live with the virus. And in that sense, we think the impact on the economy will not be very severe compared to other waves of COVID-19 before. So in that regard, our outlook remains the same. At this point, markets seem to be more concerned about the outlook for central banks, the Fed, as well as other central banks in the Euro area and abroad as well. And going forward, yes, the markets will be volatile, but at least for the US equities, I think the factors are still supportive for 2021. I think the outlook for the US business sector will still strong. The business sector has remained on a solid footing. Earnings growth has been strong with solid credit quality of large non-financial corporations. And also the Q3 results, again, was better than Wall Street analysts' expectation. And looking at other financial indicators such as corporate default rates, leverage loans, spreads remain close to historical lows. And ongoing US recovery driven by strong domestic demand should still continue to support US companies' earnings. And we think the yield curve essentially will flatten modestly as short rates rise more quickly. Yes, there are some sectors that are responding more strongly to the long yields the rises in long yields that we've seen recently. But we wouldn't overplay the implication of that because the growth outlook for 2022 still remains strong. And earnings growth should slow gradually as the economic recovery matures and as the economy continues to go towards the new normal since the pandemic. And it seems reasonable to expect the sectors that haven't benefited from the recovery so far to catch up with other sectors such as tech that have outperformed so far. And Omicron, of course, creates uncertainty, including on consumers and supply chains. But as I said before, I think we all figured out a way to live with the virus. And as supply chain constraints ease incrementally in 2022, I think there still is some room for improvement for equities. At least one thing I can say is that the household balance sheet still remains very strong. The fiscal support in 2021 was unprecedented. I think households are still in the process of drawing down excess savings. It's possible that the risk of Omicron and less support from the federal government could lead to more gradual, slower recovery of spending on services. But we still think that consumers will continue to drive the growth of the US economy. In that regard, I'm still positive about the consumer sector despite the risk from the virus as well as dwindling fiscal support. We currently expect 6.0% year-over-year for core CPI and 4.7% year-over-year for core PC in the first quarter of 2022. Because of inflationary risk from Omicron and also ongoing supply chain disruptions, we think inflation will remain high, at least in Q1 and Q2 this year. And we do think the inflation will come down over this year, but it will probably take some time. Ultimately, we think core CPI year-over-year inflation to moderate more further towards around 2.5% by the end of this year. And based on that inflation outlook, we still believe the Fed will maintain its hawkish stance over the course of this year. We think the factors that are pushing up inflation will basically revert over the course of 2022. Because of that, we think there will be a faster return to 2.5%, basically by the end of this year. There is a lot of uncertainty on supply chain disruptions. At this point, we think it can take at least 6 months from now to see some meaningful improvement in supply situation. And we saw some sign of easing in various December business surveys. But of course, we do expect some additional disruptions that the Omicron variant may cause. And that raises further uncertainty on whether these supply constraints will be resolved by sometime in the middle of this year. Let me first talk about what has changed since end of October. So starting November, the Fed's policy stance has evolved very significantly. And primarily, there has been a pivot to hawkish stance. And we think that's about risk management in response to three things. One, broadening inflationary pressures. Two, increases in inflation expectations. And three, very tight labor market conditions, which without a response, just risk unanchoring of long-run inflation expectations. And in the December meeting last year, the Fed sent a pretty strong signal, basically saying that they are more worried about these factors heading into the new year. And I think the markets are understanding that as well. And at Nomura, my team has been forecasting 4 hikes for 2022. And that's consistent with also the recent comments from the FOMC. So our expectation for the first hike is obviously March, and we expect 25 basis point hike every quarter, basically June, September, and December all together. And I think also that the minutes from the December meeting that we received last week also suggest that the Fed views the same way, and markets are finally coalescing around it. And we do see some upside risk to our forecast as well. As I said, we think core PCE inflation will moderate to something around 2.4% or 2.5% by the end of this year. If the inflation doesn't moderate further as we currently expect, the Fed could possibly raise interest rates even faster than 25 basis points, leading to something more than 4 hikes this year. But of course, that's not our current base case. But of course, the uncertainty is very high this year. Yes, we see an upside risk. Our base case is 4 hikes right now, but I think a lot of outlook is dependent on where the inflation goes. We think it's possible for the Fed to respond more aggressively if they see continued sign of rising inflation, possible signal of unanchoring of long-term inflation expectation. That could lead Fed to raise rate more than 25 basis point at one meeting. That hasn't happened since the end of Great Financial Crisis in 2008. But the minutes last week definitely showed the hawkishness and the Fed's willingness to go farther to contain the risk with respect to inflation. So since December, my team at Nomura has been forecasting balance sheet runoff announcement in July, effective in August this year. And we think monthly caps will probably start from 12 billion for treasuries, 8 billion for mortgage-backed securities, basically scaling up each month to 60 billion for treasuries, 40 billion for MBS by December. And we think the minutes from this December meeting definitely send a loud and clear signal about the balance sheet runoff starting at least this year. The FOMC obviously has already doubled the pace of tapering to 30 billion a month. And that will result in the tapering ending sometime in mid-March. And since between mid-March and July, the Fed will have enough time to communicate their intention to the markets. And that will basically pave them a way to make an announcement in July with the runoff taking place in August. The announcement we currently expect in July, and the actual QT, as markets call, will take place in August. That's our current view. I think the Fed is right now primarily concerned about inflation risk. I think it will take a lot for the Fed to actually reconsider the plan for the hike, as well as balance sheet runoff that we currently expect in July. The Fed does pay attention to financial conditions, and performance of the equity sector is part of that calculus. But also, the Fed has signaled that quantitative tightening is not necessarily a primary tool for the Fed. The Fed will probably reconsider their outlook for the rate hikes rather than reconsidering the optionality for the balance sheet runoff. There are signs that the US labor market is very tight. One of that driver is basically the retirees. The Fed has been paying a lot of attention to the quits rate. That has continued to indicate the US labor market is very tight. That all tells us that the wage growth will remain relatively elevated for the time being. And I think that is consistent with the Fed's hawkish stance that we've observed in recent months. I think this trend will continue as long as the pandemic is in full force. Of course, we think the wage growth will continue to slow as the economy continues to normalize through past the first half of this year. I think the US economy is still on a solid footing. We're not at a point yet where consumers are pulling back consumption in anticipation for higher prices. I think, yes, near-term inflation expectations have gone up, but other indicators suggest that long-term inflation expectation still remains the same. And the domestic demand for the US economy has been strong. There are some risks that we continue to see, such as the virus, higher inflation affecting consumer sentiment. But at this point, we're not at a threshold where we actually would revise down our US outlook. And the Fed, yes, will respond aggressively to hawkish surprises, to inflation numbers. That could potentially tighten financial conditions. More hawkish than expected Fed tended to negatively affect risk securities, such as equities, or sometimes even equities for emerging markets. But those are tail risks at this point. We think the Fed will be able to contain the inflation risk at this point. So I think the Omicron also poses threat to the emerging markets in Asia, as well as supply chains. Of course, the lower vaccination rates in emerging market countries pose greater threat to those economies. And also, it's to be seen if these zero COVID strategies will be sustainable in 2022. There will be increasing pressure to unwind some of that policy as the rest of the world more broadly adopts living with COVID strategy. I think the US, that's what we're seeing right now. The ongoing strength in domestic demand, despite the surging virus cases, suggests that the economy can perform even with the virus spreading around the world. Of course, the human tragedy is not great, but overall, the world, I think, will move towards the same direction. At Nomura, we still are forecasting slightly stronger growth for the emerging market economies. I think that's also because of the emerging markets becoming the factory of the world, still supplying goods and services also to the countries like the US, which has seen strong demand this year. And that could be positive for the EM economies. Of course, supply chain disruptions because of the Omicron should be monitored as downside risk.